I've been working in the markets for the past 40 years, executing over 1 million trades. Making money is about understanding hidden truths, the math, the emotion, and the relationships that move markets. Number 1, avoid wide bid-ask spreads. Liquidity is king, and illiquid markets will eat you alive. Unlike real estate or private equity, the absolute reason you trade listed markets is pure liquidity. Look for lots of volume in tight markets. Avoid low volume and wide spreads. Everything needs to be done on your terms, not somebody else's. Controlling the trade is paramount. Decent baseline volume means a minimum of a couple million shares traded a day. In the options world, look for a few pennies to a dime wide or trade near mid-price. Number 2, insist on access to everything, regardless of account type and size. Futures options, crypto, prediction markets, complex derivatives, you must have full deployment rights. It should never be an arbitrary or subjective permissioning issue dictated by an institution. Number 3, be aware of overpriced quotes and data feed fees. Exchanges are for-profit public corporations, making unregulated data fees extremely expensive. Most brokerage firms absorb data costs, but some pass them directly to you. Know what is free. If your firm charges for standard quotes, negotiate to remove them or transition to another broker. Number 4, look out for high exchange fees on specific products, like index trades. You think there are no commissions, but then you get socked with heavy proprietary exchange fees. Exchange fees can be more expensive than clearing fees or standard commissions. Check for markups. Number 5, avoid low interest rates on your free cash balances. Accounts historically pay less than a fraction of a percent on cash. Look for ETF or Treasury alternatives. I keep most of my tactical trading capital in free cash for spur-of-the-moment execution liquidity. I don't want active execution cash tied up in restrictive money funds or Treasury wrappers. But for the unutilized tail cash, maybe 20% to 35%, capture the risk-free rate around 4%. If you buy equity on leverage, monitor your margin rates closely, because margin is highly negotiable. While the standard retail rate sits high at 10% or 11%, you can negotiate it down significantly. Number 6, plan account transfers carefully. Automated transfers can be excruciatingly slow. When an account is in a transfer state, it becomes completely untradeable, leaving positions vulnerable. My absolute best advice would be to transfer cash only, close out or hedge options before moving. Many accept weak, untradeable software simply because they fear the transfer black hole. Move the cash, master the new environment, and reinitiate your positions on a fresh cycle. Number 7, look out for non-standardized risk management policies across different brokers. Regulators dictate the absolute baseline minimums, but brokers frequently inflate internal margin requirements. Audit their liquidation behaviors. Do they clear your lines flat an hour before the close? Ask these operational questions up front. You must never let an institution control your liquidations. Number 8, structural errors beyond your configuration control are completely unforgiving. Exchanges will accept zero legal responsibility for an unstable print, bad quote, or technical error. Brokers route orders to high-frequency market makers because they absorb pricing mistakes. Protect yourself. Configure your front-end software defaults to a minimum contract size to avoid fat finger mistakes. Number 9, the depth and technical capacity of support desks varies considerably across modern firms. Some discount firms still penalize accounts with an additional fee to access a live representative. Trading is a high-skill domain. Knowledgeable, elite support is your truest infrastructure differentiator. When we engineered ThinKorswim 25 years ago, our original hiring pool consisted exclusively of ex-floor traders. If you are playing in a complex business, you must employ support teams that understand the structural plumbing. Today, platforms try to lower costs by routing you to an AI agent or email-only support tickets. To compress this entire 40-year list down to the 3 most important pillars. Pillar 1, liquidity is absolute king. Never negotiate or accept friction on your executions. Pillar 2. Understand your firm's risk allocation parameters and automatic liquidation parameters fully. Pillar 3. Select service firms that field the absolute best, most knowledgeable support teams.